Gold just got hit, silver got hit even harder, and yet the most important thing happening in precious metals right now may actually be bullish. Because underneath the recent volatility, several powerful signals are beginning to line up at the same time. Inflation is cooling, the labor market is weakening, Fed rate hike expectations are fading, the dollar has been under pressure, central banks are still accumulating gold, and institutional money is starting to come back into the sector. So the question isn't whether gold and silver are volatile. They are. The real question is, are we watching the final stage of a correction before the next major leg higher? And right now, the evidence is starting to make that possibility very difficult to ignore. Let's start with what happened this week. On August 18th, gold futures dropped more than 1% to around $4,366, while silver collapsed roughly 3.3% to about $63.94. The immediate catalyst was a violent sell-off in global bonds that pushed long-term Treasury yields sharply higher. Normally, that should be extremely negative for precious metals. Higher yields increase the opportunity cost of holding gold. But then something interesting happened. On August 19th, gold rebounded as Treasury yields eased and the dollar weakened. Spot gold climbed around 0.5% to approximately $4,356. That reaction matters, because it tells us that buyers are still waiting underneath the market. The dip isn't automatically being treated as the beginning of a collapse, it's being absorbed. And that takes us to the first major bullish signal. The macro environment is gradually becoming less hostile to gold. Look at inflation. July CPI increased only 0.1% month over month. Annual headline inflation came in at 3.4%, while core CPI rose 0.2% monthly and 2.5% annually. Then came PPI. Producer prices were completely flat in July. That was below expectations for a 0.2% increase. Core PPI was only 0.2%. And that's important because producer prices feed into the inflation pipeline that eventually affects the Fed's preferred PCE inflation measure. In other words, the inflation pressure that was keeping the Fed nervous is beginning to lose momentum. And when inflation cools while economic growth and employment weaken, the probability of aggressive monetary tightening falls. That is exactly what precious metal bulls want. Now look at employment. The July payroll report was much weaker than expected. Instead of adding roughly 80,000 jobs, the U.S. economy actually lost 23,000 jobs. And previous May and June payroll numbers were revised down by a combined 103,000. That's not the kind of labor market momentum that gives the Federal Reserve unlimited room to tighten policy. And markets have noticed. Current pricing puts the probability of the Fed holding rates steady in September around 67%. That's a major shift from the fear that another rate increase could keep crushing precious metals. And here's where the gold thesis gets interesting. Gold doesn't need the Fed to start cutting rates tomorrow. It only needs the market to become increasingly confident that the tightening cycle is over. Once that happens, the direction of real yields becomes incredibly important. And if real yields begin falling while inflation remains elevated, gold becomes much more attractive. That's exactly the environment investors need to watch. Now add the dollar. The dollar has weakened over the past several months, and whenever the dollar loses momentum, gold receives an immediate mechanical boost. This relationship is already showing up. On August 19th, gold recovered as the dollar weakened and Treasury yields eased. So imagine what happens if that relationship becomes stronger. Suppose the Fed stays on hold. Suppose inflation continues cooling. Suppose employment continues weakening. Suppose Treasury yields eventually begin declining. And suppose the dollar resumes its downward trend. Suddenly, gold isn't fighting 5 different headwinds anymore. It has multiple macro tailwinds pushing in the same direction. And that is where the setup becomes powerful. But there is something even more important happening underneath the surface. Central banks are still buying gold. According to the World Gold Council, central banks purchased approximately 289 tons of gold in the second quarter of 2026. That's 62% higher than the same quarter a year earlier. China also increased its pace of accumulation. Think about what that means. Short-term traders can panic when yields rise. Momentum funds can sell when a technical level breaks. But central banks are thinking about reserves, currencies, and long-term financial stability. Their time horizon is completely different, and they're continuing to allocate toward gold. That's one of the strongest structural arguments behind this bull market, because the demand isn't coming from only one group of investors. It's coming from multiple directions. Central banks, institutional investors, ETF investors, physical buyers, and eventually, if momentum returns, retail investors. That creates the possibility of a powerful demand cascade, and we're already seeing evidence that investment demand can return quickly. The World Gold Council reported that global gold ETFs remained net positive over the first half of 2026, with holdings increasing by 18 tons to approximately 4,047 tons by the end of June. More recently, the SPDR Gold Shares ETF reportedly attracted around $2 billion of net inflows during the first half of August. Gold also briefly pushed above $4,500 last week before the bond market shock forced it lower. That's important, because it shows us that institutional investors aren't waiting for gold to reach a new record before buying. They're already positioning. And this brings us to the technical picture. Gold is currently sitting in the area that bulls desperately need to defend. The key support zone is roughly $4,320 to $4,350. As long as that region continues attracting buyers, the broader structure remains constructive. But the level that could completely change the momentum is $4,450 to $4,500. Gold has already tested that region, and once buyers can break through it decisively and hold above it, the market could transition from accumulation back into momentum. Think about what happens psychologically. A move above $4,500 tells the market that the recent correction failed to produce a lasting trend reversal. Then traders who sold the correction start buying back. Momentum traders enter. ETF flows can accelerate, and short sellers begin covering. That's how a breakout can feed itself. And then you have the next major psychological target, $5,000 gold. That's no longer some distant fantasy number. Gold already reached above $5,300 earlier this year. The current price is still roughly 18% below that January record. So a return to $5,000 would actually represent a recovery of the previous trend, not an unprecedented move. And this is where silver becomes extremely interesting, because silver has been hit much harder. Silver reached roughly $115 earlier this year. Now it's trading around the mid-60s. That means silver has fallen more than 40% from its record level. And when a market falls that far, while its underlying structural demand remains intact, the rebound can be explosive. Silver has monetary demand, but it also has industrial demand: solar, electronics, electrical applications, high-tech manufacturing, and electrification. That gives silver a second source of potential demand that gold simply doesn't have. Now imagine the bullish sequence. Gold breaks $4,500. The dollar weakens. Treasury yields begin falling. Fed expectations turn increasingly dovish. Gold ETF inflows accelerate. Central banks keep buying. Investors start chasing the breakout. And silver begins outperforming gold. That's the environment where silver can move extremely quickly. The first major level I'd watch is approximately $68, $70. Once silver can reclaim that zone, the next psychological level becomes $75. Above $75, momentum could accelerate dramatically because the market would begin targeting the much higher levels that existed earlier in the year. And this is why I think the phrase rare buy signal needs to be understood differently. It's not a single technical indicator. It's not an RSI reading. It's not one moving average crossing another. The signal is the convergence of multiple independent forces: cooling inflation, a weakening labor market, fading rate hike expectations, potentially lower future real yields, a softer dollar, massive central bank accumulation, renewed ETF demand, strong physical demand, and precious metals sitting substantially below their previous highs. When all of those factors start pointing in the same direction, the probability of another major bullish phase increases. And there's one final piece: the global debt environment. Governments around the world continue carrying enormous debt loads. That means maintaining high real interest rates indefinitely becomes increasingly difficult. Eventually, policymakers face a choice: allow financial conditions to remain extremely restrictive or move toward easier policy. If the second scenario develops, gold becomes increasingly attractive as a store of value outside the traditional financial system. And that's one reason central banks have been diversifying their reserves. And it is one reason this gold cycle could have much more room than the average commodity rally. So here's the bullish roadmap. Gold holds $4,320, $4,350. Then it reclaims $4,450. Then it breaks and holds above $4,500. If that happens while Treasury yields begin falling and the dollar weakens, the probability of a larger upside move increases significantly. The next major psychological target becomes $4,700. And beyond that, $5,000 becomes the number everyone starts watching. Silver needs to reclaim $68, $70, then $75. And if silver begins outperforming gold during the same period, that's when the precious metals trade could become much more explosive. But here's the most important point. You don't need to predict the exact day the breakout happens. You need to recognize the conditions that would confirm it. Watch the 10-year Treasury yield, watch the dollar, watch PCE inflation, watch Fed expectations, watch ETF flows, and most importantly, watch the reaction of gold around $4,500. Because if gold breaks that level and holds while silver starts accelerating higher, the market could be telling us something very simple. The correction is over, and the next phase of the precious metals bull market has begun. The biggest mistake investors make in markets like this is waiting for certainty. By the time every headline says gold is breaking out, every analyst turns bullish, and everyone starts talking about $5,000 gold, the market may already have made the easy move. The opportunity is created when the evidence is improving before the consensus becomes obvious. And right now, that's exactly what makes gold and silver so interesting. The macro data are improving for precious metals. Central banks are still accumulating. Investment demand is returning. Gold has already shown it can attack $4,500. Silver is deeply below its previous high, and the Federal Reserve may be moving closer to the point where further tightening becomes harder to justify. If those pieces continue falling into place, the next major move in precious metals may not be a slow grind. It could be a repricing, and if you're watching only the price, you may miss what the underlying flows are already telling you. Gold doesn't need permission to start the next move. It only needs the macro pressure to turn. And if that happens while buyers continue defending these levels, the next breakout could be much bigger than the market currently expects. But here's where this story gets even more interesting. And right now, there is one question sitting above the entire gold market. What happens when gold breaks $4,500 again? Gold is trading around the mid-4,300s today after recovering from the sharp sell-off earlier this week. The dollar has also eased, while the 10-year Treasury yield has pulled back toward 4.69%. That combination is important, because gold doesn't need everything to become perfect. It simply needs the pressure from yields and the dollar to keep fading. And if that happens, the market could start looking beyond $4,500. That's where momentum becomes extremely important. Think about what happens when gold approaches a major resistance level after a deep correction. There are sellers waiting. There are traders who bought higher and want to exit at break-even. There are short sellers betting on another rejection. But there are also institutions waiting for confirmation. And once the market breaks through that supply, those groups can all become buyers at the same time. That is how a resistance level turns into a launch pad. So for me, $4,500 isn't just another number. It's the confirmation zone. A sustained move above it would tell us that buyers have absorbed the supply that has been holding gold back. And if that happens while the dollar continues weakening and Treasury yields stabilize, the next upside targets become much easier to see. First, $4,600, then $4,700. And after that, the market starts thinking about the psychological level that could attract enormous attention, $5,000 gold. Now here's something most people overlook. Gold doesn't need to return to its January record before the bullish thesis becomes powerful. The metal has already demonstrated that the market is capable of valuing gold at dramatically higher levels. Today's price is still well below the 2026 record, meaning a move toward $5,000 would represent a recovery, not some completely unprecedented valuation. And that's why the current correction could ultimately become important. Markets need corrections. They shake out excessive leverage. They force weak hands to sell. They reset sentiment. And they create a new group of buyers who weren't willing to chase the previous rally. That is exactly what we may be seeing now. But gold isn't the only story. Silver could be the real explosive trade. Silver is currently trading around the low to mid-60s. And this is where the gold-silver relationship becomes fascinating. Silver has already experienced a much deeper correction than gold. That means if investor appetite returns to precious metals, silver doesn't need to simply follow gold. It can outperform it. And that's historically when silver becomes extremely interesting. Because silver has two demand engines. The first is monetary demand. When investors want precious metals, silver benefits. The second is industrial demand, solar technology, electronics, electrical equipment, advanced manufacturing, and the broader electrification trend. So when monetary demand returns while industrial demand remains structurally strong, silver can experience a powerful catch-up move. And we may not need to wait for a huge macro change to see that happen. We could simply need gold to confirm the breakout. Watch $68. That is an important technical area for silver, and analysts have highlighted the region as a near-term resistance level. If silver pushes through $68 and begins holding above it, the next psychological target becomes $70. And once $70 is reclaimed, the market could start looking towards $75. That's where the psychology changes. Because investors who were waiting for confirmation suddenly have it. Momentum traders start entering, short positions become vulnerable, options activity can increase, and retail attention starts returning. The move can feed on itself. But there is another reason I'm watching silver closely. Silver's supply situation is much tighter than the price action makes it look. The market can't simply create new silver supply overnight. A significant amount of silver comes as a byproduct of mining other metals. That means even if silver prices rise, producers can't instantly increase supply in the same way a pure-play silver producer might. And if investment demand accelerates at the same time, industrial demand remains strong, the market can become extremely sensitive to additional buying. That's where silver's volatility becomes a feature rather than a problem. Gold tends to move first, silver can move second, and then move much faster. Now let's return to the Federal Reserve, because this could become the biggest catalyst of all. The market is currently pricing roughly a 67% probability that the Fed leaves rates unchanged in September. But remember what happened to the labor market. July payrolls unexpectedly fell by 23,000. Previous months were revised lower. Inflation has also shown signs of moderation. That creates a very different environment from one where the Fed is aggressively raising rates. And the market doesn't need immediate rate cuts. It needs a change in direction. If investors become increasingly convinced that the Fed has reached the end of the tightening cycle, Treasury yields can begin repricing lower before the first actual rate cut happens. And gold tends to anticipate that shift. That's why the next major inflation data matters so much. If upcoming PCE inflation confirms that underlying price pressure is cooling, the market could become increasingly comfortable with the idea that monetary policy can eventually become less restrictive. That would be a major catalyst for gold. Because then you get the combination investors love: lower expected rates, plus weaker dollar, plus declining real yield pressure. That's a powerful setup. And there's another force operating in the background that could make the next move even stronger. Central banks are not waiting for the perfect entry. The World Gold Council reported that central banks bought approximately 288.9 tons of gold during Q2 2026, up 62% from the same quarter a year earlier. Think about that. Gold experienced its steepest quarterly decline since 2013, and central banks still increased purchases. That is one of the clearest signs that the long-term demand story hasn't disappeared. China is another important example. The People's Bank of China extended its gold buying streak to 21 consecutive months, adding roughly 20 tons in July. That creates something extremely important for the bullish thesis, a potential structural floor underneath the market. Every correction doesn't happen in a vacuum. There are buyers underneath it. And when those buyers are institutions with multi-year time horizons, the market can behave very differently from a purely speculative asset. Now add ETF demand. Gold-backed ETFs have already demonstrated that investment demand can return rapidly when the macro environment changes. And if gold breaks $4,500, the psychology around those flows could change dramatically. Because investors don't chase falling prices forever. Eventually, they wait for confirmation. A breakout provides that confirmation. And that's when the money that was sitting on the sidelines can begin moving back into the trade. And this is why I don't think the most important signal is today's gold price. The important signal is how gold behaves around resistance. If gold keeps making higher lows, if sellers fail to push it back toward the previous lows, and if buyers repeatedly step in on weakness, that's accumulation behavior. Then you get the breakout. And once the breakout comes, the technical targets become much more obvious. $4,500, then $4,600, then $4,700. And eventually $5,000. Silver could follow with even greater volatility, $68, $70, $75. And if silver begins accelerating while gold holds above $4,500, that would be one of the strongest confirmations that the precious metal cycle is entering another expansion phase. Now zoom out for a second. There's a much bigger reason this story matters. The global financial system is dealing with enormous debt. Governments need to finance deficits. Bond markets are demanding higher compensation. Long-term treasury yields are elevated, and investors are increasingly questioning how sustainable high debt levels are at permanently high interest rates. The August 18th bond market sell-off was a reminder of that pressure, with long-duration government yields reaching multi-year highs. And ironically, that instability can eventually become bullish for gold, because gold isn't someone else's liability. A treasury bond is a promise to pay. A bank deposit is a claim on a financial institution. Gold is different. It's a reserve asset that doesn't depend on another institution's solvency. That's one reason central banks continue adding it. And that's one reason investors tend to return to it whenever confidence in monetary and fiscal stability starts weakening. So imagine the perfect bullish sequence. The Fed stays on hold, inflation continues moderating, the labor market weakens gradually, Treasury yields peak, the dollar resumes its decline, central banks keep buying, ETF demand accelerates, gold breaks $4,500, silver breaks $70, and suddenly the narrative changes. The headlines stop asking, "Is the gold bull market over?" and start asking, "How high can gold go?" That psychological shift can be incredibly powerful, because markets don't move simply because fundamentals improve. They move when expectations change, and expectations can change very quickly. That's why I think the next few weeks could be extremely important, not because gold is guaranteed to explode tomorrow, but because the market is approaching a point where the macro story and the technical story could begin confirming each other. And that's what you want to see. Not just bullish fundamentals, not just a bullish chart. You want both. The fundamentals tell you why gold should rise. The technicals tell you when the market is actually confirming it. And right now, that confirmation level is clear. $4,500. Above that, the entire structure becomes significantly more interesting. Then watch silver. If silver takes back $68, then $70, and eventually $75, you could be looking at a genuine precious metals momentum phase. And if that happens while gold is moving toward $4,700, the possibility of $5,000 gold becomes much more than a headline. It becomes a technical target supported by a changing macro environment. So here's the big picture. Gold has already proven that this market can trade at extraordinary levels. Central banks continue accumulating. Inflation pressure is showing signs of cooling. The labor market has weakened. Rate hike expectations have faded. The dollar has softened. And the market is approaching a major technical decision point. That's why this correction may ultimately be remembered differently. Not as the moment the gold bull market ended, but as the moment the market gave investors another opportunity to position before the next major expansion. Because the biggest moves in markets rarely begin when everyone agrees. They begin when the evidence quietly starts changing. And right now, the evidence is changing. So don't just watch the headline price. Watch $4,500 gold. Watch $68, $70 silver. Watch Treasury yields. Watch the dollar. Watch Fed expectations. And watch the flows. Because if those pieces line up, the next move in precious metals could be much larger than the market is currently pricing in. Gold doesn't need to break its record tomorrow. It only needs to break the level that tells the market the correction is finished. And if that level falls, the race toward the next major milestone may already be underway.